Good evening and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending March 15th, 2024. And this week I'm going to title the video Cyclical Stocks Shine as Tech Dulls, and I'll dig into the details there in a minute, as well as the economic data, but I want to remind you to like and subscribe to this video and this channel and our podcast InvestTalk. And thanks for tuning in. Well, this week we had a lot of economic data, especially on the inflation front, with the CPI on Tuesday that was most talked about, but the PPI was certainly most important on Thursday, which we'll go along and look at. But the CPI came in at 0.44%, driven by food and energy. So that was that reacceleration to a multi-month high or multi-year high. The highest number, let's just say, since August, since the summer of last year. Core did dip, and you can see core excludes those food and energy, and so that's why you saw that dip a little. And you can kind of see we're in an inflation situation that is higher than you saw pre-COVID, but not where we were, at the height of all the inflation in 2021 and 2022. The producer price index PPI came in on Thursday. That also accelerated on the back of food and energy, but then core dipped down as well. Now, the Fed does tend to look at core a bit more than just raw inflation. They know that food and energy can be volatile, and they've talked about that before. So I think the market got a little worried about this number, probably a bit more worried than they should have, although I do see it becoming much more difficult to get from kind of the 3% annualized inflation down to 2. And so it's going to be difficult for the Fed to hit their target and thus lower rates substantially. We do have Fed week next week, so that'll be interesting to watch. Other economic news was the retail sales that did come in stronger, 0.58%, and that could be the reason why cyclicals accelerated this week. Import prices that did dip down a little bit. Export prices, same, but relatively flat. So that was the economic news on the day, but let's get into the charts here. And let's start with those cyclical sectors because, as I said with the title of this video, that's really where the strength lied. Here is the energy and materials, and those are doing very, very well, certainly outperforming the broad indices. If I just run, let's just do the XLE to the SPY, and you can see that accelerating here to the upside after really the S&P outperforming energy since the fall. So you're seeing energy really come back in favor, and energy is under-owned now after being over-owned in 2022. Let's see what else. Oh, industrials. Industrials did accelerate, or did kind of chop sideways, consolidated. Of the cyclical names, that one certainly did the least well, shall we say. Like I said, materials continue to be strong. But if you look at the Qs, talk about the tech doling. Yes, here are the Qs at the, it's now down for the month. The Qs are down for the month. And you can see, look at the volume on Friday. That was pretty big volume. That was OPEX. So that's certainly something of note. And what this kind of tells me is that, are we getting the reversal of the gamma squeeze? So a big part of the reason why these big, large tech names have been doing well, there's NVIDIA, a lot of this is a gamma squeeze. And Tesla's unwinding is reversing of the gamma squeeze. And same, the big question is, when will NVIDIA potentially unwind? Look at Tesla, the lowest level since last May, so 10 months. So that is in a clear downtrend. That's getting some gamma squeeze unwind. Is this being unwound because those people that are speculating on NVIDIA, on Tesla, are now speculating on NVIDIA? And you can just go look up a gamma squeeze. Basically, it is a reflexive move by a stock because of massive amounts of call buying by retail investors. As simple as that. And basically, when that momentum reverses, the gamma hedging that the dealers do is unwound. That means they sell the underlying. So it's reflexive both ways. And that's why these big cap tech names are very, very volatile. That's why they can easily drop 50% as quickly as they rally 50%, right? So that's really what's happening here. And I think Tesla, along with their business prospects, and now you have Nvidia as that next shiny object. So that's kind of what's happening in that particular space. If we look at the XLK, here is the tech ETF that also is at the lowest levels since late last month. So down on the month, whereas, like I said, the cyclicals are starting to accelerate to the upside. So that's something definitely to note. Same with small cap versus large cap. Here's IWM starting to, it really bottomed back in November, right, where small caps were outperforming the large caps, which is pretty interesting. But this is making a slow bottom here. It's not a fast one, but certainly could find some traction on the upside, especially with this volume over the last couple of days. Let's look at the broader indices. IWV, that one testing that 10-day moving average. It's the Russell 3000, so the largest 3,000 stocks. NYSE largest 2,500 stocks. So that one definitely stronger. And you can see those indices that are not as tech heavy are holding up certainly better than the S&P or the NASDAQ. Okay. QQQ. There we go. What else is good? Let's look at the 10-year. On the inflation data, did get an acceleration to the upside. Basically, as we've been saying since the fall, this pivot was pricing in 6 cuts in this calendar year, and we always said that was too aggressive. 3 was what the Fed was talking about, and 3 was far more closer to reality than what the market was thinking. So it's not shocking to see the 10-year in uptrend, and interest rates really much in an uptrend since the end of the year. So I wanted to hit on that because obviously that impacts the more rate sensitive parts of the market. Here's the utilities pull back a little bit this week, but actually not that bad, to be frank. And something to think about. I talked about it on, I believe it was Thursday's show, about how energy demand is just skyrocketing around the country. Part of it is AI, server farms being built in places like Georgia and West Virginia and et cetera. And they have cheap energy. And so, and then you have crypto mining, and you have companies bringing back manufacturing and building manufacturing plants. That creates or demands a lot of electricity. So utilities are getting a lot of demand. And so, while I don't love them because they're bond proxies, certain ones I think are going to do well in that environment. What else do I want to get to? Oh, let's look at commodities. Look at commodities. Was very weak throughout the back half of last year, and this is starting to get some traction to the upside. Oil, but also copper broke out. And really look at the dollar. The dollar is down pretty decently since the middle of February. So that's starting a bit of a downtrend. So I wanted to highlight that. The VIX, that remains relatively muted. So I do think that there's going to be, if there's going to be a pullback in the market, it's going to be something more akin to last summer, where it's more controlled rotation in markets as opposed to something that is a giant risk-off event. And you can see that with the credit markets. Here's the short-term junk, short-term treasuries. This remains in an uptrend. No real weakness here. So I wouldn't worry too much about a major sell-off. Let's get to gold and silver. Gold broke out. Silver broke out. Gold did pull back a little bit on the week, but frankly, this is just a consolidation phase. So I think you're still likely to see precious metals in an uptrend, especially with what's happening in the East. A lot of gold and silver demand in Asia because of Russian sanctions, various reasons, but a lot of demand coming out of East. The housing market in China, people are instead of investing in housing, they're putting money into gold. So you're seeing a lot of demand there. What else do I want to get to? Oh, the MOVE index. I always want to highlight that, just give you an update of what that looks like. There we go. And that continues in a downtrend. So the Treasury market, despite the fact that inflation looked a little hotter than the market expected, it's not really creating any problems in the Treasury market. And thus, the Fed, I think, can stay higher for longer. And frankly, this is something that is a bit maybe unpopular to say, but higher rates with this amount of debt that we have, it's actually inflationary because that's money going to people's pockets. It's effectively government spending. Nobody wants to talk about it, but that's effectively what it is. But that about does it. I would say we are modestly bearish near term. Obviously, bullish long term. You can't be anything but bullish long term with this level of strength in the overall market until you get some sustained downtrend. It's hard to say, you're going to get more downside because, frankly, see more upside. Trend is your friend. Although near term overbought, recent micro trends are hinting at a period maybe similar to what we saw late last summer, early fall. Pullback. Here, I'll run a fib for you. Right, would a pullback into 4,800 on the S&P from 5,100 now into this consolidation period, would that be a shocker? Absolutely not. And frankly, I would say that's the base case. But ultimately, that would just mean, bring the market roughly back to flat on the year. I still think we get a positive year in equities in a election year. That's typically what you get. So you can't really think. You have to be ready for potential of a major trend change, but with the backdrop of government spending, election year, earnings expectations going higher, Goldman Sachs just updated their expectations of the S&P earnings for this year. It's hard to see a reason, a catalyst outside of some left field event to really pull the markets down to a substantial pullback. So near term, modestly bearish, but medium to long term, still modestly bullish. I think that's about it. Appreciate you all tuning in and liking and subscribing to our channel as well as our podcast, InvestTalk. Hope you have a wonderful weekend. A reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial and those associated. Have a wonderful weekend.